Today, we're giving a company a full financial health checkup. We're going to look past those big, flashy numbers you see in the news and find out what's really going on under the hood. So you see a headline like this all the time, right? A company rakes in $5 billion in revenue. Sounds incredible. But does that one number really tell us if the company is successful? Is it actually healthy? Well, not so fast.
Not even close. That revenue figure, it's like knowing someone's height but nothing else about them. To get the real picture of their health, you need a doctor to check their vitals, their blood pressure, their heart rate, the whole shebang. And we need to do the exact same thing for a company.
So, our financial checkup really boils down to 3 key tests. Each one looks at a different vital sign of the business, and together they help us diagnose its true health. First up, profitability. Is the company any good at actually making money? Then we've got liquidity. Can it handle its bills that are due, like right now? And third, solvency. Is this company built to last for the long haul? Let's jump right in with the first test. All right, first up, profitability. You can think of this as checking the company's metabolism. How good is it at turning all of its activity, all those sales and operations, into actual, profit? Probably the most important profitability measure is the net profit margin. It's the ultimate bottom line. I mean, after the company pays for everything, its supplies, its employees, interest to its lenders, and even its taxes to the government, what's left? This number tells us exactly how many cents of every single dollar of sales the company gets to keep. But profit isn't just about what's left over. We also have to look at it from an owner's perspective, and that's where return on equity, or ROE, comes in. It asks a really simple, powerful question. For every dollar that we, the shareholders, have invested in this company, how much profit is it generating? A high ROE is a great sign that management is fantastic at using investor money to make more money. Okay, so the company can turn a profit. That's a great start. But can it survive the day-to-day grind? Our next test, liquidity, is like checking the company's financial blood pressure. Can it handle its immediate bills without breaking a sweat? The most common way to check this is with the current ratio. It's pretty straightforward. It compares all the stuff the company can turn into cash fairly quickly, its current assets, against all the bills it has to pay within the next year, its current liabilities. A healthy range is often somewhere between 1.5 and 3, meaning it has at least $1.50 ready to go for every dollar it owes soon. But here's where it gets really interesting. We can get much stricter. The current ratio might look okay at 1.8, but what if we take out inventory, which, can sometimes be hard to sell in a pinch? That gives us the quick ratio, and whoa, it drops to 0.9. That's a bit of a red flag. Now, what if we only count cold, hard cash? That's the cash ratio, and it's just 0.4. All of a sudden, this gives us a much more concerning view of the company's ability to pay its bills right now. All right, time for our final test. This one looks deep at the company's foundation, its bone structure. Is this company built on solid ground that can handle a shock? Or is it at risk of, fracturing under its own weight? To check that bone structure, we look at the debt-to-equity ratio. This gets right to the heart of the matter. It compares what the company owes to what the owners actually own. It really helps us understand a crucial question. Who's in charge here, the shareholders or the lenders? And in our example here, just look at this. 65% of the company's funding comes from debt. Think about that for a second. That means lenders have a much bigger claim on the company's assets than the actual owners do. Now, that kind of borrowing can juice returns when times are good, but it makes the company incredibly vulnerable if things go south. You can really look at this in 2 ways, but they're just 2 sides of the same coin. The debt ratio shows you what chunk of the company's assets was bought with borrowed money. The equity ratio shows you what chunk was funded by the owners. They're basically opposites, and they always add up to 100%, giving you that full picture of who's funding this whole operation. Okay. The tests are done. We've checked the metabolism, the blood pressure, and the bone structure. Now it's time to pull all the results together and give our final diagnosis on the company's overall health. And looking at this report card, it's a very mixed bag. The company has a strong metabolism, it's great at turning sales into profit, but it's also got some seriously high blood pressure, with that low quick ratio suggesting it could have trouble paying its immediate bills. And its bone structure? Well, it's a bit fragile, relying way too heavily on debt. This shows you that one good number, like a high profit margin, is never the whole story. And that's really the key takeaway from all of this. The goal of financial ratios isn't to find some magic number that screams buy or sell. They are your tools for investigation. They empower you to look behind the headlines and start asking much, much smarter questions. And that is the real power of a financial checkup. It doesn't just give you answers, it completely changes the questions you ask in the first place. So now that you've got the tools, think of a company you follow. What's the first question you'd ask about its health?